One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. Hello and welcome to the Investment Banking Insights podcast. My name is Alex Mason, your host, and you're listening to the show dedicated to helping you learn both the technicals and non-technical aspects of investment banking. And I'm just so excited that you're here with me. We're going through the discounted cash flow analysis, all the basics that you need to know related to that topic. And this is a fun one for me because I feel like at a high level, it's just one big process that you use to get the value of a company based on its financial fundamentals and intrinsic value. But there's so many different moving pieces of it. You got all these assumptions, you got these different steps. And so it's a lot more nuanced than if you were to look at it at just like high level and say, oh, we're just summing up the present value of the cash flows and that's it. Well, yeah, but what actually goes into it? And that's what we're exploring now at this part of the series in the podcast. And we talked about how to calculate the weighted average cost of capital, the different portions. You got the equity portion of the equation, the debt portion of the equation, and the preferred stock portion of the equation. And we talked a lot about the debt component and a little bit about the preferred stock component, but we kind of glossed over this cost of equity factor. So let's go ahead and talk about how you calculate the cost of equity for a company. And it's a bit of a nuanced discussion because it's not completely straightforward, but I'm going to share with you what I've learned so far. So here is the equation for cost of equity. Cost of equity equals your risk-free rate plus beta multiplied by your equity risk premium. Cost of equity equals your risk-free rate plus beta multiplied by your equity risk premium. Okay, so what do these terms mean and where do they come from? Well, let's start with the first term, risk-free rates. Risk-free rate is the rate of return an investor can expect from government bonds. The term risk-free, it's kind of a non sequitur because there's no such thing as a risk-free asset, right? If there was an asset that you and I could invest in with literally zero risk, we'd be buying that all day long, right? Nothing like a guaranteed rate of return. But there's no free lunch in the universe, right? As physicists like to say. So there's nothing exactly free, but the best proxy that we have for a riskless asset is government bonds. Because at the end of the day, whatever government you have governing the country that you live in has ultimate political power and authority. And governments have the authority to tax their citizens in order to raise capital. So that's where they get their revenue. That's what's actually paying interest on the bonds to the bondholders. So that's where this risk-free rate comes in. Now, in the context of the United States, we're specifically talking about specific financial instruments. And typically we're talking about the 10-year or 20-year U.S. Treasury bonds. So you could go to treasury.gov right now and look up the rates, the yield rates that is, for a 10-year bond, a 5-year bond, a 1-year bond. But we're usually looking at 10-year bonds or 20-year bonds and looking at the yield of that. So if you bought those bonds, you would be pretty darn sure that you're going to get your capital back and you're going to get the interest listed for that bond at maturity based on the taxing power of the United States government. So that's what the risk-free rate is. Now, moving on in the equation, we have this thing called beta. And honestly, I'm still trying to understand completely all the nuances of beta, but what I understand so far is that it's a measure of volatility relative to the market. And some people define this as riskiness of comparable companies. So if you have a business that tends to correlate very well with the market. It goes up when the market goes up at about the same rate. It goes down when the market goes down at about the same rate. Well, your beta is going to be very low because there's a low correlation. But if the market is going down and your stock is going up, then you might have a higher beta. You might have a higher level of volatility relative to the market. And we know that different companies respond in different ways as far as their relative valuations. And so beta tries to kind of encapsulate this when looking at the cost of equity for a company. And then the equity risk premium. Let's talk about this factor here for a moment. The equity risk premium is a factor that accounts for how much investors are willing to pay for equity in a business above and beyond the risk-free rate. So we talked about the risk-free rate, investing in government bonds, pretty sure you're going to get your money back. But what if we want to make more money than what the treasury bond is yielding? I mean, treasury bonds in America right now, at the time I'm recording this, I think the 10-year yield is somewhere around 3.5%, somewhere around 3.5%, 4%. So higher than it has been in the past decade or so, but still relatively low by historical standards. But hey, what if I want to make more than 4% on my money or 3.5% on my money, and I want to do it in a different way? Well, I might invest in equity. I might invest in stock. I might invest in a private or publicly traded business. So how much do I want to pay above the risk-free rate in order to get that higher return? That's what the equity risk premium is all about. Now, there's a lot of debate on what the premium actually is. I mean, economists sometimes use what is called the capital asset pricing model, or CAPM, to help determine this. But basically, we look at what investors historically have been willing to pay extra for stocks versus treasury bonds, and then use that historical basis, that gap in valuation, in order to make projections about how much investors should be willing to pay for now for assets above bonds, equity above bonds, that is. Now, I spent a few minutes talking about this. At this point, I'm getting into the weeds here, but I feel like it's important that you understand the context you're going to be building models in one day, because you may be working on billion-dollar transactions, quite literally. So you might want to also account for other factors in the equity risk premium that might play into your model, such as the size of the company or the industry of the company. Small companies typically grow faster than larger ones, just as a general trend, and some industries are typically more economically attractive than other ones. For example, there's research that shows that over the decades, healthcare, consumer staples, and tobacco companies have historically outperformed every other sector in the U.S. stock market. So that's just an interesting bit of trivia for you. But it kind of plays into how you might make projections, because if a certain industry is going to be more economically productive than another one, you might want to have a little bit of a different equity risk premium to account for that. So equity risk premium can be calculated in different ways, but there are institutional sources where you can look this up. Just know kind of what's behind it. There's this general idea that as an investor, you would pay more for an asset that's going to give you a higher return than an asset that's going to give you a lower return. And so you have to get a sense of what that premium is going to be and what that cost is going to be. That plays into your cost of equity formula. So back to the overall cost of equity formula, your beta is multiplied by the equity risk premium to account for both premium and volatility. And then you add this to the risk-free rate in order to arrive at your cost of equity. So that's cost of equity in a nutshell. I hope that made sense to you. Like I said, I'm still somewhat new to these concepts myself, so I hope I explained it clearly to you. But that's what I got for you today here on Investment Banking Insights. My name is Alex Mason, your host. I'm so grateful that you're listening, and I'll see you on the next one.